Hello everyone, I hope you are well. Today we have another video as part of the technical analysis series, and we will be going over the Fibonacci retracement and extension levels. A quick note to thank you very much for your patience and polite requests when it came to making a video edition of this lesson, which was previously in Google Slides or PDF only form. So thanks for sticking around, and hopefully we'll make it worth your wait. Now, a couple things. If this is your first video, the first is that it shouldn't be. I do recommend looking through the technical analysis playlist in order. The stuff that I'll cover here will make more sense. And second, the way I typically run these lessons or videos is more of a lecture series type of setup where, it's unedited, one run, and we sort of go through it on the go, if you will. So I hope that format is agreeable to you. And with that said, let's jump into the disclaimer real quick. Neither this presentation nor anything on my Twitter, Telegram, or any other medium or mode of communication, including private correspondence, constitute financial advice. You know this, I'm not a financial advisor, I hold no formal qualifications in this area, but I will bet a lot of money that there is someone in your jurisdiction who does, and that person or those people are the ones to speak to. Trading is very risky, especially when it comes to highly volatile and very speculative crypto assets. Trade entirely at your own risk, and this is for entertainment purposes only. With that said, the usual round of shoutouts. I am ICT, Crypto Red Pill, Trader Dante, and Trader Main have all helped me out directly or indirectly when forming my opinion of and methodologies pertaining to Fibonacci levels. So thank you to you, gents. As always, we'll quickly skim through the outline of this lecture. They tend to be quite lengthy, so it helps to break it down, especially if you're coming back to it and reminding yourself of a certain part of it, and so on. So we'll start off with some general remarks. Then we'll talk about setting up the tool. We'll then talk about anchor selection. It's very easy to say, oh, you just go from the swing low to the swing high, or from the swing high to the swing low, but there is a level of nuance involved, and I will hope to cover that. And then once we've got those two things established, we will look at using these levels, the Fibonacci levels, to identify support, resistance at all-time high, and then advanced concepts, which is really just one concept, but it sounds a lot cooler when you say advanced concepts, and then how I use the Fibonacci levels myself, and then we'll conclude. So as always, the general remarks. The first one is the focus of this lesson is the Fibonacci retracement tool, and although the name suggests, obviously, retracement, it can be used to draw extension levels as well, as you will see. The second point is that you can ask 5 traders how they use fib levels, and you'll likely get 5 different answers. I'm giving you the straightforward ways to use this tool, and hopefully nothing too fancy or contentious. And then thirdly, understanding what swing highs and swing lows look like is very helpful, and this is not only in regard to using the Fibonacci levels and setting them up, but also with your trading more generally, as those of you who watched the institutional order flow video, which is hopefully all of you at this stage, will know. And then a quick note for the pedants, the 0.5 or 50%, whatever form you prefer, isn't a Fibonacci number, but it's an important retracement level nonetheless, as we might see in a couple of our examples. A general comment about fib levels and their use: they're great for confluence, and they're especially great because it doesn't really matter how you trade, whether you're a cloud trader, price action only, your harmonics, whatever it may be, it's very likely that you can incorporate Fibonacci levels into your setups. Very good and versatile tool to have in your arsenal. And there's lots of wiggle room when it comes to setting up fib levels, as you will see, so experiment and see what works for you. And then the last one, more of a technical point, that I don't use Fibonacci levels to project support or potential entries at all-time low. We will discuss how to use them for prices at all-time high, and as sort of logically inconsistent as it may seem, I simply haven't found the useful application for this tool when price is at all-time low. Right. So setting up the Fibonacci retracement tool outlined in video, that is my cue to outline in the video. Making sure I don't have Discord or anything else unbecoming open. Right, so this is TradingView, and if you'd like the Fibonacci retracement tool, it is the third button or tool down on the left-hand side. You click on the arrow, and it should be about halfway down Fib retracement. I recommend putting a star next to it for your favorites, and for easy access. And then in terms of setting up the customizing the settings, whatever it may be, do go ahead and just draw it out, and something like this should come up if you're using the default settings. So now what we're going to do is we're going to click on the settings button, and it should give us this menu. Now this is very, it should be done according to preference, but some settings which I find useful, certainly using one color can be nice. And then if you want specific retracement or extension levels that you like, let's say the 618 is one you believe is really important, you can make that stand out in a different color. So that's the use one color tool. Another tool I like is the extend lines tool, and that means I don't need to sort of stretch the fib setup over a very long time or whatever. When jumping from time frame to time frame, it's simply always extended, so I usually have that ticked. Background, I'm not really a big fan of how it sort of clutters up my chart, so what I do is slide this to as far right as possible to really fade away the colors and not interfere with your chart. And then again, the very personal setup that I like is to go right labels on top. And so it ends up looking something like this. Now, in terms of the actual values themselves, the default ones are fine for the first part of this presentation, similar to the ones you see on screen now, that I would, of course, tick the 1.272. But again, even here, the whole element of preference comes in. Maybe there's certain extension or retracement levels that you prefer which aren't ticked on default, or maybe that some of the ones that are ticked on default you don't like. That will come down to you and your experience. This is more of a general setup type of thing. And if we go to the next slide, you will see that these are the settings I use. If you, for whatever reason, want to copy them, and as you can see here, I've got some negative fib levels. If those look weird to you, don't be surprised, because we will cover them in the advanced concepts. But that was just a very short overview of how to get the tool up and running and get into the settings so you can dig in and do your own thing. So before we get into how we can project these levels to give us potential support areas, resistance areas, extensions, and so on, it's really worth paying quite a bit of attention to what makes a good Fibonacci anchor. Now, what I mean by Fibonacci anchor, as the word suggests, is that as you can see with the Fibonacci retracement tool, you need 2 points in order to draw out these retracement levels. So you need to pick. So it's basically 2 clicks. You anchor 1, anchor 2, and depending on how you set them up, they will be the ones projecting your levels. So they're obviously quite important. So as I mentioned at the start and in general remarks as well, understanding what swing highs and swing lows look like is helpful for effective Fibonacci anchor selection. And that is because in many cases, again, as we'll see with the chart examples, the anchors for your fibs will be swing highs and swing lows, the base of a rally and the top of a rally, and vice versa. So it's very important to be very familiar with these terms in order to do this anchoring effectively. So a swing high, and again, we'll have this nice diagram in a second, but just from the words themselves, description of what a swing high is. A swing high is when you have a high which then has a lower high on both sides. And then a swing low is when you have a low and then you have a higher low on both sides. Now, we're going to talk about swing highs and swing lows in slightly more detail, but inevitably the question on people's minds will be wicks or candle bodies. Now, I use wicks to actually identify where the swing low and swing high, swing lows and swing highs form. You can, however, use the candle bodies to anchor your fib. So let's say you have a swing low instead of using, the lowest price point, the bottom of that wick, you can instead use the lowest candle close in that area. Or the same with a swing high. Instead of using the top wick, you can use the highest candle close in that area. In terms of when to pick which one, I personally tend to use wicks, but as with anything, I recommend experimenting, use the bodies. If you have some outrageous wick, it could be, like a pump and dump type low cap altcoin wick, it might make more sense to use the body. It really is a preference thing worth playing around with, and in most cases it shouldn't make a massive difference anyway. I do recommend you be consistent though, with your wick or body selection. Don't mix and match. So more details on swing high and swing low. So let's go back to our description. A swing high is a high with a lower high on both sides. And here we're paying attention to the wicks because these are, especially when looking at the high, it's the highest point that the price made. So this using my advanced Goldman Sachs charting tools, also known as Microsoft Paint. I have a wonderful diagram here. So let's look at what this actually looks like. So this is the structure of a swing high, which you can look at, which can be derived from just the 3 candle structure here: high, lower high, lower high. But then if we're looking for the specific price points in the wicks, so this is your high, meets our description, and then we need a lower high on both sides. Do we have a lower high to the left? Yes, because this high is lower than that one. Do we have a lower high to the right? Yes, because this high is lower than that one, and thus the swing high is formed. Now, the swing high is actually confirmed when, the candle, the most recent candle, the candle to the right, if you will, closes. Because obviously, if we're looking at hourly bars or whatever it may be, there's no point using this as your swing high before this candle has closed, because for all you know, it might go on to make a higher high, thus invalidating the setups. So we only use candles that have closed for our reference points when looking for swing highs and swing lows. And then, the opposite is true here, that you have a low, and then our test, going back to our criteria, is there, or in this case a criterion, is there a higher low on both sides? So this is our low. Is there a higher low to the left? Yes, because this low is higher than this one. And then do we have a higher low to the right? Yes, because this low is higher than this one. And as soon as this candle closes in this type of formation, once the candle has closed, again, the candle to the right, the more recent candle, whatever you want to call it, only at the close of that candle is the swing low or the swing high confirmed. So let's refine this concept a little bit. So we know what swing highs and swing lows look like, but there are loads of them, obviously, especially if you become trained to see this sort of wick structure or 3 candle structure, whatever it may be. There are lots of them. So how does one identify which specific swing high or swing low is a good place for a fib anchor? Now, there is no objective answer to this, and this speaks to the fact that so many traders will set up and use fibs differently, but I can certainly share my preference, and a preference which I think is logical, is that the deep and obvious standout or standout swings are the ones that tend to make good fib anchors. So the swing points that your eye is drawn to when looking at the chart, regardless of the time frame. Now, if you watch the institutional order flow lesson, which again you should have if you're looking at the Fibonacci video lesson, we're asking the same question, which is that which swing high or swing low will entice traders and sort of bring the most attention to itself? What stands out? I don't want to overcomplicate this. In most cases, it is simply quite self-evident which swing high or swing low is the good one or the right one, if such a thing is possible. But if you're still unsure or lack confidence on this, it's almost hard to go wrong by going with your instinct that this is the swing low that jumps out at me and is the low, and then this is the swing high that jumps out at me and is the high. And as we'll see with our chart examples, it's really not that difficult. But I know this is an issue that a lot of traders face, like, oh, there's so many dips and so many swing lows, where do I start the fib? So I do think it's worth laboring this point as I am in this slide. So in summary, swing highs and swing lows, which usually form at the top or bottom of a move make for good anchors. Once you know what a swing high and swing low looks like, or look like, which we covered here, when refining which specific one to choose, because this structure comes up a lot, the good ones tend to be the obvious ones, the ones your eye is drawn to, and then these criteria that we want swing highs and swing lows, and we want the good ones that stand out, they are valid across all time frames. So you can apply these regardless of whether you're fibbing, which is a contorted verb which I've allowed myself to use, big daily moves, or smaller time frame scalps. Right. Finally, we'll get the charts momentarily. So we've now talked about how to set up the tool, and now we've spent some time talking about what makes for a good anchor, being able to identify swing highs and swing lows, and being able to refine which specific swing highs and swing lows would make for good Fibonacci anchors. So now, with all that knowledge in mind, how do we actually set up these levels to get support or potential entries and get resistance and potential targets or exits? So focusing on the first one, the basic premise is that we can use Fibonacci levels to identify where price may retrace to after moving up. So the context being, we've had a rally and then the market is pulling back after a leg up, and you're wondering, well, for example, market structure's broken, the market looks bullish, how do I get in on the pullback, or where do I get in on a pullback? And Fibonacci levels can certainly assist us in this analysis. Now, I'll first go over the how, and then we'll look at chart examples and apply the how. So theory first, and then example. So when we're mapping or drawing Fibonacci levels for support, we do so in the following way. The first is we identify the base of the move or the rally that we're trying to get in on the dip of, if you will, and that will usually be a swing low. Okay? Then we identify the peak of that rally, so the high that price made before it started pulling back, and this is usually a swing high, or again, not to overcomplicate things, the top of the move, which is usually quite self-evident. Then we select our Fibonacci retracement tool, as covered in the beginning of this video, and since we know it is a 2-click tool, click 1 is the swing low, click 2 is the swing high, and then the levels will appear. So let's look at some chart examples of this. Now again, the slides to this presentation will be in the description of the video itself, so feel free to stop, pause, do it at your own pace. Now before I jump to the chart examples, do take them with a pinch of salt, a pinch at the very least, because they're all hindsight examples. I'm not going to sit here and, for however long it takes and give you live examples of it working or not working. The more important part is to understand how to set up the tool rather than finding amazing examples. It's just the application of the theory. It's all hindsight anyway. So, going to our chart examples, we have an example here on the Bitcoin daily time frame, right? So let's clean up the chart. So we've got our Fibonacci retracement tool here. And by the way, a trading view tip, if you do want to get the precise wick or the precise close, you can just use magnet mode, which will snap your cursor to specific places. So let's say we're trading Bitcoin and we're looking at the daily time frame. You can see the low of 6K came in here, and since then, market is just rallying away. And the first significant pullback, you could start looking for pullbacks or looking for shorts or whatever else once you see this shooting star and breakdown of this big bearish candle here. Now, this is also a swing high, as you can see, a high, lower high, with a big move to the downside, and you want to get in on a dip because the market, by breaking this swing high, so you can see this tool comes up everywhere and it's very useful. By breaking this swing high, the market has proved to you, it's a break in market structure, that the market's bullish to some extent at least, and so you're looking to get in on a pullback from, let's say, this resistance level. So how do we use Fibonacci levels that assist us in that? Well, let's go back. Identify the base of the rally as swing low. Now, even without mapping out a swing low, if you're in this move, so the move is from the 6K bottom to the 11.8K high, what is the low of that move? Where is your eye drawn to? It's obviously going to be this bottom, right? So where does our first click go? Click 1 is the swing low. Okay, excellent. This is our first click. And then what do we do after that? Click 2 is the swing high, which is either a swing high structure, but more often, again, not to overcomplicate things, a self-evident top. What is the self-evident top of this move from here to here? Well, it's obviously this wick. Here we go. And as you can see, our retracement levels appear, well, at that, depending on when you did it, obviously, well, below market, if you're doing it on this candle or this candle, whatever it may be. And as you can see in this case, the 0.382 level came in as support. Price failed to close below it, I believe. I think it closed just on it, if I'm correct. And then the market rallied up, and although it failed to make a higher high and broke down, etc., at that point, you had confluence of whatever support level you're looking at here, that there is a Fibonacci retracement level in the vicinity or in the same area. Let's look at another example. This time on the hourly time frame. Right, so again, euro dollar, let's say, you know, you're bullish this and you believe that this move down has taken out just a bunch of stops and it's just a trap. And you can see the market came in, SFP'd this low, I believe anyway. I could check without deviating too far. Yeah, so SFP'd this low, so a false break of this low here to suck in the shorts before squeezing them further. And then the market is rallying away. Now I wonder, okay, so we are here, excuse me. Right, and so the market's rallying away. This is the high it's formed and it's pulling back. And it's proven to you that it's bullish for whatever reason. Either you believe too many shorts are trapped under here, this swing high is broken, whatever it may be, you want to get in long. So we're going to be using the Fibonacci retracement tool to give us, obviously, retracement levels to see where the market might find support. So going back to our checklist, the base of a rally or a swing low. Now, even without mapping out every structure, which is the swing low that stands out to you? For me personally, it's this one. So you have a low, a lower low, and a higher low. So even from a sort of bigger swing low structure, this is the one that really stands out. Okay, so the first click goes there. Where does our second click go? The swing high or the self-evident top. Well, if we're trying to catch the retracement of the move from here to here, where is the top? Well, it's going to be the top of this wick. Again, this is just straightforward, nothing too fancy. You can see the market came down, found support at the 382 level again, and then moved up from there and gave you a nice reaction. So again, nothing too crazy. We've identified the move, this low to this high, and we want to get in on a pullback of that move. And so we fib the swing low here, low, lower low, higher low. So from the perspective of this low, high low to the left, yes, high low to the right, yes. Just for our extra test, does it kind of jump out at you and stand out the most in this area? Also, yes. And then where is the top of the move that we're trying to catch the dip of? Well, it's obviously going to be this wick. And if that's not enough for you sort of instinctively, you can see it's a swing high here. High. Does it have a lower high to the left? Yep. Does it have a lower high to the right? Yes. We can comfortably put our fib at the top, and the 382 level acted as support. I think those are the two examples I have. Yeah. And again, examples, hindsight, just to prove the point, you know, go and backtest them for yourself, try them out live, whatever it may be, and we will talk a bit about the ways in which to use this drawing tool. The last thing you want to do is to, without looking at support resistance, indicators, anything else, just go and trade fibs only. I don't think that's a particularly good use of your time, but we will talk about that as well. Right, so let's get back into the presentation. So now the other way to use Fibonacci levels, almost everything flips, right? So here we were going from bottom to top looking for support, and now we're going to go from top to bottom looking for resistance. Now, it's sort of logical that it works that way, because if we're trying to find support, the way we're actually using the tool is saying, this is the low, this is the high, and I want to find retracements of that move. And then so when you're looking for targets, the same logic applies, just in the opposite direction. this is the high, this is the low, and I'm looking for retracements of that move. So it makes sense in that way. And if it doesn't make sense in that way, don't worry about it because the instructions are here. Basic premise, as mentioned, is using Fibonacci levels to identify where price may find resistance after a move down. So, once the low is in or a local bottom has been formed and price is rallying up, where might we expect to find resistance? So how do we do that? Again, pretty much the opposite of what we did one slide ago. We want to identify the peak of a rally. So we start from the top, which will usually be a swing high. We want to identify the bottom of the move down. Again, usually a swing low. We select our Fibonacci retracement tool. And this time, again, we don't go from bottom to top. We flip it and we go top to bottom. And the Fibonacci levels that appear will project plausible resistance levels. So we've covered these two examples of support. Now we have some examples of resistance. And again, daily time frame for Bitcoin here. Let's go through our logic again. And again, on the daily time frame, I do like the bigger swings. So if we're looking at the 6K low, which swing highs really attract our attention? I mean, these are swing highs, but with this type of structure in place, that's not really where our eye is drawn to. This is certainly attractive. This is a nice swing high, but for me personally, on the daily time frame, I really like mapping out deep swings, big moves, so there's significance in the fib levels because they're not too clustered together. So if I fib, let's say from here to here, you can see the fib levels are fairly clustered, 8.39, 9.8, at least in relative terms. Whereas if I go from the all-time high to the low at 6K, the fib levels become a lot more spread out. And it's sort of less down, they're less arbitrary if there's more distance between them and they're not all clustered together. So for me, first of all, this kind of stands out on the chart. And if it's not enough for you, it's the all-time high. And if that's not enough for you, there is, of course, a swing high structure in place. High, lower high to the left, yes. Lower high to the right, yes. So let's consult our manual once again. We want to click 1 as the swing high and click 2 as the swing low. So this is our swing high as we just demonstrated, and the swing low, the one that really stands out once again, especially if we're trading around here, will be the 6K bottom. And once we've established that, the levels that are projected, we expect to act as resistance. As you can see here, the 0.382 did a great job of, chopping price action in half, if you will, here on this move up. Shooting star above it, failing to close through it. And then here as well, we did get a close through it, but hopefully you're paying close attention to the market structure at this stage and realizing that price has failed to close above this high and certainly make a higher high from here. And so the resistance level generally holds and price sells off. But certainly this first interaction is the important one. All-time high, swing high, down to local bottom or bottom of 6K. You're watching this rally. 236 doesn't give you a reaction. I'll talk about that towards the end. But then your 382, again, fibs are about confluence. What does it give you? It's a move into this resistance, failure to make a higher high, failure to close above this 382 fib level, and this sort of shooting star candle, which is then confirmed as a swing high the following day, right? But again, what we're really interested in for our purposes in this lesson is the application. We're going from high to low, the extended levels or the levels that are projected, we expect to act as resistance, which it certainly did in this case. And another example, and you know, those of you who are vigilant or observant will notice that I'm using different time frames. Again, this is on the hourly instead of the daily. Much smaller move in relative terms, of course. Well, and in absolute terms, but a smaller move nonetheless. So let's look here. Your eye should, where's your eye drawn to? So we're going to go, if we're looking for targets, we're going from the swing high to the swing low. Which swing high really stands out to you if we're sort of trading in this area? For me, I know it's this. It's this area. It just jumps out at you that this is a high and we sold off from it, right? Keep it simple. And then if you need confirmation, you see a high, low high to the left, low high to the right, and it stands out above, you know, these highs here and these highs here. It is the significant swing high among the swing highs either side of it. We want targets, so our first click is going to go there at the top. And then where do we go? We go to the swing low. Well, where did the low come in? That's, you know, you could even ask yourself a simple question like that. Where did the low come in? Which bit or which candle jumps out as a swing low? For me, I certainly know it's here, right? This low here. And then again, in relative terms, you have a low, high low to the right, high low to the left. That's a swing low, sorry. And then even from a more zoomed out market structure perspective, or, you know, candle structure, whatever you want to call it, you have a low here and higher low to its left here and higher low to its right here. It is sort of the bottom out move. Now, some of you might think, hey, isn't this a better swing low? But I personally never fib sort of into the past. I'll always go either from the past. Yeah, so basically never fib. I think an easier way to express it is I don't fib from right to left. From right to left. Yeah, that's right. My fibs will always be from left to right. Gosh, I hope that makes sense. I don't fib backwards, basically. I don't fib backwards. Right. So that's another example. And as you can see here, this is the obvious swing high. Click one. Obvious, self-evident, whatever adjective you prefer, swing low. And so the levels that are projected, we expect to act as resistance or certainly make good targets for resistance, or however you want to incorporate them into your trading system. And that was certainly the case for the 382 level, the 0.5 level in this move here, and then you can see the 0.618 gave you some nice reactions as well. Let's go back to our slides. So now one of the more popular applications of this tool is using Fibonacci levels to identify resistance or targets once price is at all-time high. So at that stage, we simply don't know, or simply don't have any price action or previous price history to use as a reference for where we might expect to find resistance. So the best we can do, or at least one of the things we can do, is map out Fibonacci extension levels to give us a rough idea of where we might expect price to turn. But it's obviously less reliable because it's much harder to find confluence where there is no price history. Now, using Fibonacci levels to identify resistance or targets at all-time high is indeed very similar to using Fibonacci levels to identify resistance or targets, which is logical. And the way we do that is that we identify a swing high and or the all-time high, right? Those aren't mutually exclusive. And then we identify a swing low and or an all-time low, and we go from high to low, right? And then Fibonacci levels, including extension levels, will appear. Let's look at some chart examples. So we have ARK Bitcoin here. And on altcoins, certainly, for me and my preference, I do like going from all-time high to sort of local bottom. And this is what I mean by I don't fib in the past. So if I'm looking for support, I'm still going from past to, you know, I go from left to right if I'm going for support. And then even if I'm going from resistance, I'm going from left to right. I hope that point is clear. I'll never do something like right to left. I will not do that. So sort of fibbing backwards is not something I do. It'll always be from left to right, or again in the other direction from left to right. I don't fib into the past. Hopefully I've nailed that point home. I just didn't want any confusion. So in this case, again, where is our eye drawn? Which high is our eye drawn to? Hopefully, unless I'm crazy, you'd agree with me here. You have a high here. Does it have a lower high to the right? Yes. Left, sorry, yes. Lower high to the right as well. And it's sort of top, quite simply. That will be our click one. And then if we're trading somewhere around here, what is our swing low reference point? Where did the market sort of bottom out? And my eye certainly is drawn to here. And we can analyze that from our normal sort of perspective. This is a low. Is there a higher low to the right? Yes. Is there a higher low to the left? Yes. Now you might ask yourself, hey, doesn't this look equally good? Why can't we use this? And it does have this structure immediately as well, but this is really the standout point. And then if we just look a bit to the left, this is a lower low to its left as well. So using sort of basic terminology, this is where price bottomed out. And so sort of where it topped out and where it bottomed out, a lot of the time you won't need any more complexity beyond that. But I know some people need reassurance, as I mentioned, so the swing high, swing low type structure and where your eye is drawn to will hopefully allay all your fears. So once we're here, once the price action is say around here, or price is rallying away, or for example, when you might be interested in targets once these highs get taken by a big candle like this, and you're thinking, okay, well, market structure's broken, maybe even here, and saying, I want to go long, but I need some targets. And so the fib levels that are projected act as resistance. We see the good reaction from the 0.5 here before drawing down. But now if price started going towards an all-time high, so if price went beyond this 122k sat range, I'd certainly be looking at the 1.272, 1.618, 2.618, etc. for targets once any frame of reference I have is gone. You could use this sort of big corrective move alternatively, and one isn't necessarily better than the other. It is down to preference to a certain extent. You could also use the more recent corrective move as well, from this swing high to this swing low. Right? Slightly more, it's a smaller move. It's a smaller move, but it is more recent. And at that point, your extension levels, certainly once the 1.618 was gone, because we still have all-time high as a target, you'd be looking at the 2.618, 3.618, and then probably 4.618 instead of the 4.236. Right. But again, with the 2.236, 0.272, 414, etc., I would just play around with it and see what works for you. Maybe back test it, live test it, whatever it may mean. I didn't really end up using much beyond the 1.618. But it is worth playing around with and seeing what works for you. So again, when we're trying to get a reference point for all-time high, we're doing the same as we would for targets from swing high and to swing low, but the difference being that if price were to start a run to an all-time high, and once this high got taken out and we've run out of price history, not counting this sort of listing thing, our remaining frame of reference are these extension levels, which are 1 point something, 2 point something, 3 point something, and so on and so forth. We can use Zcash as another example, and a lot of the time, and with fibs generally, if you use them, or if you'd like to use them like I do, which is your higher time frame, bigger fib type of stuff, the higher time frames themselves will make it very easy to draw fibs and cut out a lot of noise. Obvious swing high, does it meet our structure as well? Well, yeah, it's the top. And also lower high to the left, lower high to the right. Great. That's our top. Whereas our bottom, well, where did Zcash bottom out? Quite obviously here. Okay. And then I know that if price starts gunning for a new all-time high, and if this, this swing high that we use as our reference point gets taken out, beyond that, I'll be eyeing the 1.272, 1.618, and then from there onwards. Most often, these are the two levels that come into play the most when using fib extensions, the 272 and 1.618. But sometimes, with a crazy rally like Bitcoin or some other altcoins, depending on the time of year, I suppose, you will end up using the higher extension levels also. Right, so to recap, before we jump into the advanced concepts, and you can stop watching the video here if you want, although I know that with a title such as Advanced Concepts, not many will. So what we've covered some general remarks. We've talked about setting up the Fibonacci retracement tool, how to actually get it to work. We've spent a lot of time identifying swing highs and swing lows, and what makes for good Fibonacci level anchors. And the swing highs and swing lows will also be helpful in your trading generally, so that's an added bonus. We've talked about using fib levels to identify support entries. we go from low to high. We've talked about using fib levels to identify resistance targets. We do the opposite. We go from high to low. And then we also just covered using fib levels to identify resistance or targets at all-time high, which is basically doing this, but then also getting the extension levels for when we run out of previous price history as a point of reference. So advanced concepts. What am I talking about here? So having just done that summary, it should now be obvious that thus far we've learned how to identify potential support resistance using Fibonacci levels. But one can also use the same Fibonacci setup, this bit is crucial, to set targets if price finds support resistance at a fib level. So for example, if that's not clear to you, so in this case, I hope it's still up. Is it? No, right. So let's go to the Bitcoin one, which is definitely still up. So in this case, you can see that we fib this out and then price comes to the 0.382. But at that point, it's not, one doesn't typically use the remaining fib levels above market to use as targets. It doesn't tend to make much sense. They tend to be a bit too close, and that's just not how they're used. So once it's bounced from the 382, you're like, okay, well, the fib setup has done its job, and I'm going to use my other technical tools, you know, support resistance, indicators, whatever, to figure out where the target for the trade should be. Now, one of the advanced concepts that I'll now cover is that you can use the same Fibonacci setup to actually give you targets as well if the fib levels do their job. So in the Bitcoin case, you can use the same Fibonacci setup once it bounces off the 0.382, for example, as it did there, to actually give you a target for the setup as well. Now, how does one do this? So this concept I learned from ICT, and you know, his free videos. He has a very unique way of using fibs, and what I'm going to show you is certainly not how he uses fibs. He has his own thing that doesn't get taught anywhere apart from his free videos and mentorship, and I'll include links to the videos to the best of my knowledge in the description. So I've only chosen the negative, the idea of negative fib levels comes from ICT. I don't want you thinking that what I'm about to show you is like, oh, this is how ICT uses fibs. It's not. And if you want to learn how he uses them, look at his videos, just to get that out of the way, because I know he's understandably protective of his content. So, with that little disclaimer out of the way, how can we use the same Fibonacci setup to give us targets once, you know, a fib level is acted as resistance, to give us where it might drop to, or once a fib level is acted as support, where price might bounce to? So in order to do this, let's refer back to the setup slide and ensure that you've customized your parameters to include negative fib values. So if we take us here, you can see that 0, 236, 382, these are all positive in your normal fib levels up to here. Then you have your extensions, 618, 2618, 3618, and 1272. And again, this isn't gospel. Feel free to use your own and test them and so on. But then the negative fib values is the minus, basically these same values just with a minus 0.236, minus 0.382, minus 0.5, minus 0.786, and minus 1. So just make sure that's all set up, and then we can go over how we can use the same setup to actually give you targets. So assuming you've now set that up, it's quite simple. You set up your fibs as normal. So ascertain whether you're looking to buy a dip or sell a rally and fib accordingly. So again, if we're looking to get in on a retracement, we're going from swing low to swing high, and the fib levels act as support or may act as support. And if we're looking for resistance areas or targets, we'll go from high to low, and then the fib levels will act as resistance or may act as resistance, whatever. And once you have that set up, and again, we'll get chart examples in a second if it's not unclear, the targets for your setups, once the fib level has done its job, will be the negative fib levels, including 0. Right? Now that may have gone over your head, but don't worry, the chart setups should hopefully clarify things. Let's look at this example in the euro dollar hourly chart. Now, where have I... Right, so this is what we're looking at. let's go over it without all this noise. So how would we normally do things? I think I might even be able to show it slightly easier than normal. Okay. So fib lessons. Let me just make sure I've got the right. Okay. So how would we normally, let's say we want to get in. So you see we've had an impulsive move on the euro here. And what has happened is, again, I think I've covered this exact setup. This low, a false break of this low, market starts squeezing and takes out, breaks market structure, takes out these swing highs. You're thinking, okay, well, market's proving to me that it's bullish. I want to get in on this. So how would we normally do it? Well, you've learned that we'd go from the swing low, which I would suggest is here, to the swing high, which I would suggest is here, and that would project retracement levels. As you can see, you get a very nice reaction, this sort of tweezer bottom off the 0.618. But now, using our original concepts, we don't really have a target for this move. It'll be our next resistance, our next SR levels, here, whatever it may be. But the fib setup itself doesn't give us a way of setting a target. Now, if we include our negative parameters, the following happens. So we'd go from the swing low to the swing high. I don't know why it's appeared, but this might be even more helpful. Let's quickly add on our negative levels. So minus 0.236, tick, minus 0.382, tick, minus 0.5, minus 0.618, minus 0.786, and then minus 1. Right? This is how you'd set it up. So look what happens at this stage. At this stage, once we've added in those levels, using the same setup, we actually get fib levels which are above market. In this case, possible areas for resistance. So before, we would only have the fib up to here, up to the 0 level, and from then you'd have to make your own way. But in this case, you can see that by adding these negative fib values, the same fib setup, low to high, shows you support, can actually project plausible areas of resistance as well. Now, what I'd like to bring to your attention in this case was where the top came in, if you will, or the sort of high from which price sold off the most aggressively or gave you the biggest reaction, is what ICT labels an equilibrium swing, which is when price essentially swings the same size or the same number of pips or whatever measurement of the instrument you're trading as the original setup. Now look, to prove that point, you can see that in this case, price went, I'm not going to get into the terms, let's say 91 units, okay, from the 1 to the 0 level, and then look what happens when we move that from the 0 and to the minus 1. It lines up perfectly. That's what's called an equilibrium swing. So price made a swing, we got in on the dip, and then our target, potentially one of the targets, is a swing of the same size. And that's what it did here. So again, to reiterate, the swing that we're looking to get in on was 90 units. And from the high, it swings again, the same number of units to here, before selling off. But generally, when using this concept, you can use any of the negative values, any and all perhaps of the negative values. I've just noticed the 0.618 is, there we go. Right. So we're using potentially any and all of the negative fib values as targets or where to take profit, again, depending on the market structure and whatever else you're using to gauge the strength or weakness of the market. One thing I will mention, and I'm going to clarify this bit here, including 0 in case price fails to make a new high or a new low. So we obviously don't have access to this price action when we're doing this. So we fibbed from low to high. We've gotten in at the 618 level, but for all you know, when the market rallies away, it might fail to make a higher high. So that's why it's wise, in my opinion, or potentially something worth considering depending on the setup and so on, to take some profit at this 0 level in case price returns to the area where it sold off and fails to make a higher high. I hope that makes sense. So this is the low, this is the high, we caught the dip, and when price is rallying at this stage, we don't know whether it's going to actually break this area where it sold off, or whether it's not going to break it and, fall all the way back. So a good way of protecting yourself is to ensure you shave some off, or, move your stop, whatever it may be, to this place to hedge against the fact that the market may fail to break out or break down if you're going in the opposite direction. But generally, the negative fib levels make for good targets. Confluence that with your other gauges on the market of how far you believe it's going to go, and a cool concept, again this ICT concept, is this equilibrium swing, that the market made this swing, retraced, you got in, and then it potentially is going to make the same size swing again. Let's look at one more chart example. Hourly chart right here. Let me see exactly what I've got drawn so I don't get confused. Right. So this is the opposite scenario. And again, I mentioned this kind of thing was good for scalping type things. So let's look here. You see the market has made a high. So what stands out to you here? Hopefully you'll agree that it's, and actually I'm going to make this vertical so it's easy to, so I don't lose it. Right. Let's see if I can do this. Okay, excellent. I haven't lost it. So for whatever reason, be it the head and shoulder, potential head and shoulders, or whatever other evidence you have the market is topping out, you're looking for potential entries for a short, or possible short-term targets if you bought, let's say, the false break of this low, whatever it may be. Ignore all that. Let's quickly think back of how do we set targets for, well, using Fibonacci levels. Well, we know, or targets or resistance, I should say, using Fibonacci levels. So we know that for support / entries, we go from low to high. And we also know that the opposite is true for targets or resistance. So what is the swing high, or what's the swing high that stands out? I believe this is a good candidate. Swing high stands out, it's the obvious top of this whole leg. Lower high to the left, lower high to the right. Good. Now, without access to all of this price action, where does the market sort of bottom out, or where does that rally come to an end? Well, it would be here, in my opinion. This wick. Let me just go to magnet mode here. And the reason I say that, again, quite obvious low, quite obvious bottom, low high to the left, low high to the right. And so as the market starts creeping back up here, you're perhaps looking to short, and your bias is to short, whatever it may be. As you can see, the market gives you the reaction of the 6.618. And at that point, you can use the same fib setup using our 0 and negative values to give you some targets for the trade. As you can see, effortlessly breaks through, clean break of the 0 level, and then the market's looking to make new lows. And where does it find support? It finds support quite nicely with this tweezer bottom, if you will, at the 0.382, and certainly sort of accumulates a bit exactly at the 0.618 before running up and then selling off further. Again, take all of these examples with a pinch of salt. It's hindsight. It's more to show you how to actually draw and set up the tools. But generally, this advanced concept is quite cool because, as we've seen with the Aussie dollar example and with the euro example, it doesn't leave you in the dark once a fib level has done its job. So here you're like, okay, well, I've learned that to get support, I need to go from low to high and get a retracement level. And, you get a perfect hit of the retracement level here. You're thinking, oh, great, the market's reacting, but where do I go now? And, you'll revert back to your normal support resistance tools. But the cool thing is you can use the same fib setup to give you potential price targets. And those are the negative levels here, including the 0. And that's the sort of bullish application. We're looking to get in on a retracement. And here is the opposite, that we're looking, so in the euro example, we're looking to get in on a dip. And in this example, we're using this setup to sell into a rally. High to low, 618, and downside objectives become your 0 and then negative fib values as well. Now, how I use Fibonacci levels. So as always, do your own research and see what works for you. This is simply a tool and make it fit your preferences. And more than almost any other lesson, or perhaps any other lesson that I've done, there is a lot of room to customize and adjust and play around with this tool than a lot of others. Regardless, what are my preferred uses? Well, I prefer the deep daily swings. Using fib levels on big daily time frame moves to really get spread out significant fib levels. Now, another thing is I use fib for confluence only. I will never trade a Fibonacci level on its own or trade it blind unless I have some other supporting evidence, usually in the form of a support resistance level, so like a horizontal line, to suggest that the market will react to it. And the reason I do this is not only just, for more confirmation or for more certainty, but even when using stuff like, well, the advanced concepts being one example, if it bounces here, and then I have all these negative fib levels as my targets, how do I know which one to choose? Or how do I know which one to pay attention to? Well, the answer would be the one which has confluence with like a support resistance level or something else, right? Or the same can be said here. Once this starts cooling off, how do I know whether it's going to be the 236, the 382, the 0.5, or the 0.618, or the 0.786 that's actually going to provide the support? Well, the answer is the one that lines up with a support or resistance level, if any. And the same applies for all of it. So when you're drawing fibs either way, you'll get quite a few fib levels, as we can see here, especially if you've got the advanced concepts, the negative fibs. So it can get quite tricky if you're just like, oh, cool, man, I learned how to use Fibonacci levels. I'm just going to trade them now. That is very difficult because there's quite a lot of them. And unless you have, exogenous evidence or non-fib evidence, if you will, to suggest that a level is going to hold, it becomes nearly impossible to know which ones to trade and where to let the trade run. And now the last little bit is I pay the most attention to the 0.382, 0.5, and 0.618 levels. This is more of a preference thing and just something I've noticed from trading and testing and whatever else, that these are the so-called significant fib levels that tend to get a much higher strike rate and tend to be more successful generally. But again, test it and see what works for you. And so conclusion. Let's go back to our final slide. So thanks for not thanks for watching, but I do thank you for watching, and hopefully you learned something new. And I will take the opportunity to reiterate that, as with all my other lessons, but especially this one, tailor the tool to your needs and preferences. So which extension levels you want to use, which extension levels you don't want to use. Do you want to use fibs to set targets? Do you want to use them to find areas of support? Do you want to use both, neither? One of them. What context do you want to use it in? Do you like the setups for scalping? Do you like it for the deep daily swings? It's a very versatile tool. And now that you know at least some of the different ways to use it, I recommend you spend some time playing around with it and tailor it to your needs. And I will reiterate this point again, which for me is very important, confluence only. When you learn a new tool, it is very tempting to get all excited about it and go back and check every single fib and every future fib and try to, trade them all. But you will get lost. There are just sometimes too many fib levels. And the way I ascertain, or at least increase my probability of knowing which specific fib level is going to give a reaction, is using confluence. So usually the fib will come after I've drawn my support resistance levels or whatever tools you use to map the market. And so if you're looking at some of the chart examples and thinking, oh God, there are like so many fib levels, how am I supposed to know which one will provide support, resistance, and so on? The one with confluence will typically be your high probability bet. And beyond that, thanks very much for watching. As I mentioned, if you want to donate towards the database of free technical analysis lessons, feel free. There is a QR code to scan and a Bitcoin address at the bottom there as well. And good luck and happy trading. I'll see you for the next lesson. And just a general thank you to you guys for the crazy support over these weeks, months, whatever, and I look forward to providing more value to you and interacting with you all. Thank you very much. I'll see you for the next one.